Thank you for trying financetrainingcourse.com, an online collection of risk, Basel, treasury, and portfolio management resources created by risk and treasury professionals. Hello, and welcome to our session on stress testing. Stress testing is a subject that went mainstream immediately after the financial crisis, when a number of regulators in North America and Europe asked their banks to evaluate the impact of a sequence of events and conditions on their balance sheet and capital levels. The idea was to identify institutions that would need assistance or would need intervention by the regulator so that the interest of the depositors could be protected. While it may not seem so, the tool is actually not that new, something that has been in use in the financial services space for quite some time. Banks, insurance companies, funds use it on a regular basis, have been using it for quite some time. Beyond that, even within the space of financial modeling, we've done a fair bit of work on the sensitivity analysis or sensitivity testing side. Now, when you look at the field or the subject of the topic, there are actually a handful of main themes that should be covered when you start studying for this topic. The first and the most important is what are the range or ranges of value that we're likely to see against which the stress test would be done. Okay. And beyond that, if you're familiar with the field of statistics, how does our choice of distribution of these values and results change the recommendations that we make on the stress test side? So that's number one. Question number two is, what exactly are you measuring in a stress test? So are you measuring capital? Are you measuring revenue? Are you measuring P&L? Are you measuring resources? Are you measuring dollars? And just as important, when you measure this, how do you know what's a right value, what's an extreme value, what's an abnormal value? So what's the benchmark for these measures? Number three, we spoke earlier that the primary reason why the regulators ran the stress test after the financial crisis was to evaluate the safety of institution. And when you speak about safety, the primary determinant of safety within the regulatory world is capital. So there are, going back to the question we just asked here about what are you measuring, there is a lot of work within stress testing that focuses on capital adequacy, and on another slightly misunderstood, slightly misused term, which can possibly best be described as, let's just call it probability of failure. Issue number four is a list of challenges and problems that you're likely to see when you put together a stress test. And foremost within this list of challenges and issues is, how do you manage the fact that there are markets that move in certain directions, there are positions that move in similar directions, and yet there are times when correlations tend to break down. So how do you factor? I think the best possible symbol that I can pick for this is sigma AB. How do you factor covariances and correlations into your stress test? How does that work? So in our session, in our course, what we'll try and do is try and take a quick look at all four of these areas and then decide what's the best possible way of building a stress test for a financial institution. So let's start with question number one, issue number one, theme number one, which is how to decide or determine the range of values. So if you are in the process of building a stress test, the first thing that you do, let's take a simple scenario. Let's assume that I am an investment manager or a treasury manager who has a portfolio. And within this portfolio, so I have a portfolio. Okay. And within this portfolio, let's say I have securities and assets worth $1 million. So as a portfolio manager, when I'm looking at a stress test, I can actually classify or categorize the days that I see as part of my work in three categories. The first category is what we call the normal world. So about 70% of the time, the days that I see fall in this specific category, and this is nothing to write home about. It's just an average day. About another 20% of the time, I see days that are actually quite interesting and to put it mildly, challenging or difficult. And I see just like the normal world above. Let's call this the normal world. This is the normal world. Let's call this the interesting world. It goes both ways. Interesting based on depending on whether you making money or you losing money. Then I have a third world, which is what I call, let's call this another 9%, and I call this the challenging world. This is the challenging world, and this challenging world is challenging because while I see this, once in maybe 10 days and 100 days, where I see days where things get actually difficult, and from a occurrence or a likelihood point of view, we're basically saying that if I have 1,000 days, looking at 1,000 days of history, about 700 days would fall here, about 200 days will fall here, another 200 days may fall let's just use the same, another 90 days will fall here, and then there is the last category, and this last category is what I'm really interested in, which is the last 1%. And these are my bad days. Alright, so and same scale, using the same scale, see about in 1,000 days, I'll maybe see 10 days that fall in this specific category. So when we say that we have, if I as a fund manager, as an investment manager, as a portfolio manager, when I look at normal days, interesting days, challenging days, and bad days, how do I relate? How do I demonstrate this in a tangible form? A great example is that, let's say this is the value of my portfolio. So the value of my portfolio is 1 million. On a normal day, this value will move by about plus 1% to minus 1%. On an interesting day, this value will move from, let's say, about plus 2% to minus 2%. Okay. On a challenging day, it may move from 0% to about, let's say, 4%. And on a really bad day, it might move by as much as minus 10%. Right? So, which means that if I were to take the same scale and turn this into numbers, you're saying normal days when markets move, in terms of my exposure, I see gains and losses that range from about plus minus 10,000. Okay. On interesting days, I see a range that goes from plus minus 20,000. On challenging days, I see movements of up to 40,000, and on my really bad days, I see movements of as high as minus 100,000. Right? So if I flip everything that we've done here, if I take what I've just spoken about and turn this into something that we can use, what we're really saying that, look, if I have a range of values, right? And remember the scale. What was the scale? The scale was a total of 1,000 days, with 700 days from the normal world, about 200 days from the interesting world, about 90 days from the challenging world, and about 10 days from the really, really bad day universe. So now if I were to build a scale, I would say that, look, 70%, 20%, 9%, and 1%. So I'd say, okay, the 10 days that I'm interested in fall here in terms of probabilities. Okay, the 90 days are still rare, but fall somewhere around here. Okay. The 200 days that we spoke about earlier fall about here. And then the bulk of the days that we see fall about here. Okay. So the scale, if you think in terms of the scale, the range of values, right? So this is minus 10%, this is plus 10%, this is where we go. Sorry. So this is I suppose your interesting days. So this was about minus 4%. And if you're lucky enough to see maybe a plus 4% here, and then these are your bulk values, so minus 1% and plus 1%, right? Now if I hook all of these lines and if I connect all of these lines, what I see there you go. What I see is sort of a curve, right? And if I do this nicely and neatly and cleanly, if I had a large enough bucket or a large enough sample, I actually end up with a distribution of values that ranges from minus 10% to plus 10%. So with respect to a stress test, my interest is not here. I'm not interested in what's happening here. I don't care. This is stuff that happens on a regular basis. I don't think there is a need for me to worry about this. And we'll talk about this in a little bit more detail when we come to capital. I may be interested in what happens on those abnormal days, but in most cases, what you'll see is that a focus of a stress test, again depending on what kind of positions you hold, may be on this extreme 10% side here or here. So if you bought stuff and your risk and your exposure is that prices will fall and you lose money, you want to focus on the minus 10% side. If you've sold stuff and your expectation and your risk is that prices will rise, and you would have sold too early, your exposure is here. If you take a step forward and link this discussion to capital, if as an institution you only have capital from here to here, so your capital sort of covers your normal days, and which is fine. There are lots of businesses and ventures and industries where having sufficient capital to cover normal days is enough. You don't have an issue. You'll have an issue if your normal day suddenly turns into an interesting day, your interesting day turns into a challenging day, and your challenging day turns into what we've identified and marked as a really, really bad day. Right? So, so from a thinking point of view, we can mark this as operating capital, right? So this is operating capital is the amount of money that we need to make through most of our days without any challenges and problems. Now, given the fact that you know that variations are possible, given the fact that you understand that there are going to be instances where numbers are going to be much, much different, it's also useful to actually have another layer of capital, and let's call this layer of capital as risk capital. Now, we use the word risk capital because we're saying this is the risk that your expectations would not be realized, that you would actually see a variation that you may not necessarily be prepared for, that your business may not necessarily be prepared for. And you provide for that risk by providing an additional layer that would sort of protect the business from going under if your normal day turned into an interesting day. From a regulatory point of view, however, you're perfectly fine with op capital, operational capital, and risk capital. From a regulatory point of view, though, whether you're a regulator or you are, so this piece, this is the piece. Let's use a different color. That's the piece. So if you're a regulator, or if you're a regulator, or if you're a rating agency, or if you're a creditor, in all of these instances, your primary focus is on the hard left edge. And your concern is, how much capital have you put aside to protect yourself if your interesting day turns into a challenging or a bad day, right? So if you take this as a little further, the next natural question that comes up is, before you can answer this question, how much risk or exposure do you need to take? You actually need to understand how big or deep or dangerous is this hole, this entire piece. How big is this piece? Which then, if you go back to our list of questions, we asked that one of the things that regulators focus on is capital adequacy, capital, and probability of failure. And one of the questions that we have to answer using the stress testing process is to figure out how the values that we've put aside in our mind, in our estimate, about the amount of capital that we need to move things forward, how do those values relate to this number? Thank you for trying financetrainingcourse.com, an online collection of risk, Basel, treasury, and portfolio management resources created by risk and treasury professionals.